Better reporting for me means faster learning, and that is a key thing I can do in terms of my analytics setup optimization in order to double my e-commerce profits. This is my tactic number 9 in this series. So if you want to become a reporting ninja, just keep on listening. I want to go through it in iterations and go from like a simple to a bit more complex setup and tell you what has been worthwhile for me in real practice. I highly recommend a pretty simple e-commerce spreadsheet that I'm going to show you that just has the truth from different data sources in it, because the truth that you see in your Google Analytics can be very much different from what your bookkeeper is telling you. And maybe in between there is the shop, because shop analytics, because they're the basis of what you're exporting in your tax statements, they're 99% close to the truth. They're usually informed about most of the returns you have. Your analytics tools usually are not. Then Google Analytics as the basic, then Facebook Analytics reports, and the rules that we want to create in order that allow us to scale up or down our, for example, paid marketing efforts. The whole reason why we do this reporting is to make decisions and to act. And we need to define those rules when we are willing to scale up stuff and when we need to start scaling down because we don't want to go broke. So this is the very simple version. Yeah, it's based on what we saw in the parts before. It's a very simple e-commerce spreadsheet. I want you to have this at the very minimum on a weekly basis. How much did you spend, let's say on ads? How many impressions did you get? How many clicks? How many visitors resulted out of those clicks? These are not the same. Yeah. How many purchases you got? How much money in terms of net revenue you got? And what your return of advertising spend was for this time period. And of course, some people are not going to have yet a very cash flow positive spreadsheet like this one. Having a ROAS of 300 is for most people roughly acceptable. Of course, we all want to spend less for more revenue, but this is already pretty reasonable. But what if you're spending more money than you earn? Or you're spending more than your margin? Then somewhere here, stuff got lost. Too few people who visited your website actually bought something, and you need to make improvements. This is why I want to go into a much more detailed version of this simplified spreadsheet. So this is the extended e-commerce conversion spreadsheet, which has a simple philosophy. Every step that the user takes needs to be documented in terms of amount, cost per step, and the conversion rate based on the previous step. So let's look at this. Again, these are the same numbers that we looked for at before, just more detailed. Why do I make it more detailed? Because people are dropping off in this funnel. This is a user journey, and you have lots more people watching your ads than buying your stuff. Yeah, you're losing people here. And the points where you're using the most people, where the funnel starts to shrink, these are your biggest opportunities to make optimizations and improve your cost per acquisition and increase your customer lifetime value. And that is the fundamental balance that we are trying to figure out in our e-commerce model. And in order to see where people get lost, we need to understand each step of the conversion. And in the last part, I showed you like how to get consent from the tracking, and in the part before, like how do you set up in a very simplified way, in a very short explanation, how to set up those conversion events so that you're able to see those numbers. Now we go through it with a fine comb, and I'm curious if you actually expected that so many steps are necessary for a customer to actually buy something, and what can go wrong and go right in here. Again, we are looking at a time period, let's say it's a month, in which we spend 5,000 euro. You could be spending this in a day, it doesn't matter. It is pretty normal on Facebook and Instagram to pay 10 euro for 1,000 impressions, which results into 500,000 impressions of our ads about our amazing product. In a 30-day period, it's absolutely okay if they see it 2.5 times. So 200,000 people that reach actually see your product. They see it on average 2.5 times. And now people can make a big decision. And this is the first big barrier that people need to take. You can force people to watch your ads, to see them, because they are in the newsfeed, and not all platforms have functioning ad blockers. Gladly, yeah, for us marketers. Now they need to make this big decision of clicking or touching on a link and going to your website. And we usually look at the click-through rate from the points of impressions and how many people click through. But I want you to start thinking in your user journey as something that individual people walk through. You can absolutely see this in absolute numbers, but I've chosen in this expanded spreadsheet to look at it as a single person who clicks and then makes many clicks, but we still count them just as one. This is what's called a unique click, and a unique click-through rate of 3% in this case. Maybe you're seeing usually your click-through rate, lower click-through rate on Facebook. A 1% and higher click-through rate is considered acceptable for me. If they see it 2.5 times, yeah, like we can see here, a click-through rate of 3% is not too much. I see that very regularly. But if you just look at the absolute numbers, this might look a bit too high. But we're looking at unique click-through rate, and you can set this up in your Facebook columns. That results into 5,927 clicks, as we saw before, but now we can see how much did we pay for that step. That is called the cost per click, the CPC. 84 cents, pretty reasonable still. 90% of people land on my website. That happens because people get lost. My website maybe takes too long. There is never 100% of people actually coming from a click to my website. In this case, we assume an otherwise 100% conversion rate towards like cookie consent. Yeah, we get to track everybody in our fantasy. Now, this results into 5,300 users, and those users start a session, maybe start multiple sessions, we just count them once, maybe we should better call it unique viewers, and this costs us 94 cents. Now let's look at the rest of this journey. Here people have already made the decision to go to our website, but now the next big barrier. I could just send cheap traffic from Outbrain, Taboola, some native advertising or display ads in mobile apps that have really strong clickbaity ad systems and get them to my website. But if they do not put something into the shopping cart, they are obviously not interested in what we're doing. So this is the next most important step. How many people add something to their shopping cart? Out of those 5,000, it is 1,334. That leaves 35% of the people that have come to our website. These percentages are always based on the step before, in case you're wondering. So an add to cart cost us €3.75. A unique checkout, that is the action after a person puts several things into their shopping cart and then initiates the checkout, 1,000 people reach. So 75% of people do that, and that costs us €5. And 500 people out of that 1,000 actually manage it. So 50% of people who initiated the checkout also buy something. In the example before, this number was much higher, but this is more reasonable. Overall, I also listed the purchases per session, per user who visited there. I guess user would be more accurate in this case, is 9.4, because that is usually considered the e-commerce conversion rate. The total e-commerce conversion rate based on sessions and not a unique user perspective usually is much lower. It's considered 3% is already high, 4% is excellent, 9% you only ever reach if you look at the unique users or if you are retargeting people who have been on frequent shoppers on your mailing list. But that results into a cost per purchase of €10. Yeah, nice round numbers. Of course, I tweaked the numbers there a little bit to reach those nice numbers. All right, but what happens after the purchase? So again, this is a huge barrier. People just surfing and checking out stuff and people actually leaving money. If you start to internationalize your e-commerce store, you will realize this, because people in your former market are very more likely to convert than people in a new market, and maybe people in markets that don't have that much money. They serve, they add to cart, they initiate the checkout, but maybe they're not happy with the shipping rates, and there's a much higher break-off rate there. So there we got another barrier. People who have just visited and interacted, and people who are now actually buying. We have 500 purchases here. The cost per purchase is 10 euro, but we also need to consider the costs of goods sold. In order to simplify this, I took a product that costs 60 euro in net prices plus VAT. So maybe it's a little smart home device like an Amazon Echo something. Yeah, it costs 30 euro, and maybe it costs the company 10 euro to produce it, ship it, and consider refund rates and other costs per goods sold. They need to spend 10 euro per purchase on ads. That leaves them 10 euro in profit. Yeah, this is the most important thing, that this number is higher than 0. Since they have spent now in total 10,000 euro, how does that 10,000 come together? We have 10 euro per purchase, we have 500 purchases. This is 5,000 euro plus the 5,000 euro that we spent up there for ads. We get cost of 10,000 euros. We got revenue of 15,000, and that leaves us a profit of 5,000 euro. So we spend 5,000 euro, and after deducting all costs, including the ad spend, we are left with 5,000 euro. Pretty fun game to play. And this is just a return of advertising spend of 3. If you are looking at costs of net revenue divided by costs. But if you look at it in terms of like financial investments, your return of investment, if you invest 100, you get an additional 100, so 100% upside. Not bad. If you're able to do this in a month, to double your money every month, that is pretty significant. If I would offer you that deal as a stockbroker, you would send me to jail. If I offer you anything that is more like 10% per year in investments, I'm considered a charlatan. But in e-commerce, we're absolutely expecting these kinds of returns of our investments. And this is why I'm not very keen in putting my money into stocks, because I play this game every day and it makes much, much more fun than waiting for some measly 5 to 10% on my home or my stock portfolio investment. If you want to get a Google Sheets version of this, I put a link down below at getpirateskits.com/ecom-sheet. Then you can check the numbers and see my formulas in case that is interesting for you and you want to apply this to your own business. It's a very simple spreadsheet. Maybe I will beautify it in the future. So now you see how detailed actually the user journey is. And to be honest, there could be several steps included as well, like visiting the product detail page or category pages, or in the checkout, the shipping side, the payment options. I already simplified it. And we have here, what do we have? Like 30 lines. It's because as growth marketers, we need to look at the amount of the conversion event happening. Let's say an add to cart event. We need to look at the cost and we need to look at the conversion rates. Why is that so? Because the conversion rate we can actually impact. We can optimize our store in order for more people to put something into their shopping cart. We can optimize our store for people who have initiated the checkout to purchase more. For example, by offering more fitting payment solutions or lowering our delivery fees. So the percentages are in our control, and the costs are always just a result of the percentages lining up. Okay, I hope this was not like making you crazy or anything. I hope you find this as helpful as I do when I think through my scenarios. I usually do this kind of spreadsheet or have this in my tracking tool. And it doesn't actually matter what business model it is. I would do this for a B2B lead generation funnel just as well. But the lines would be just called differently, like cost per lead, cost per call, cost per offer sent, conversion rate of offer to contract sold, stuff like that. But you probably want to go beyond the spreadsheet. Your shop analytics, this is a screenshot from Shopify store, is pretty close to the truth. And you need to find the data that you put into the spreadsheet somewhere, right? And your online store is usually the best source for information like the true average shopping cart size, how many purchases you actually have, what your refund rate is, what your average shopping cart size is, your customer lifetime value can be estimated here best. And you get many interesting KPIs already out of your shopping cart analytics. What it doesn't do is communicate with your ad platforms and your other tools that you're using directly. You need to have that separately. Another tool that I love to use is Google Analytics. This is like my default tool that I go to. As you can see, here is a screenshot from the e-commerce part of it, where I can see my revenue, e-commerce conversion rate, the transactions I have, the average order value. I can see a nice histogram over time and see maybe how the upcoming Black Friday impacted my sales and the conversion rates of my discounts. Can very easily manage timeframes in Google Analytics. And you can be extremely sophisticated in your attribution tracking within Google Analytics e-commerce tracking. And this is something where you might be interested in getting some help by like a nearby agency. I like to use Google Analytics mostly because it's very neutral. It shows me the user flow across many channels. Like if I look at my Facebook Ads Manager, I of course only see the data from the Facebook Ads Manager. But here I can see the data from my SEO traffic, from my social influencer campaigns, and from my Facebook ads. And you see graphs like this where you get to see like, oh, what is my best performing product? And you can slice and dice this data for you to find the treasure, that you're looking for. But Google is not very good at estimating your customer lifetime value. And the tool that is actually really good is Facebook Analytics. So why is Facebook so good at it? Because it essentially sends your Facebook user ID with every interaction after consent, and that allows you to track pretty well across many devices that you use, as long as you have like a login into Facebook or Instagram or WhatsApp in some capacity. And you get this graph. This is Facebook Analytics. Now, this is different than your Facebook Ads Manager. The Facebook Analytics actually receives data from all of your traffic sources. It's more neutral than the Facebook Ads Manager. And if you go to facebook.com/analytics, you can see what you already have there or not. If you go to this tab called lifetime value, you see something very interesting. Here you see, if you press this paying user button, and I usually go for a 90-day time frame, here you can see how the customer lifetime value increases over weeks. 90 days are roughly like 12 weeks. And you can now see that in this case, the customer lifetime value starts at $50 and goes to $100 within 100 days. And you can also scroll down and see this as a cohort analysis. So why am I excited about this? Especially those averages that I see up here. It says on week 0, that is the first purchase a user makes, it's €49, and at the end, after 12 weeks, it's $100, not euros in this case. Why is this so interesting? If you are considering how much you should be spending on ads to acquire a customer, you usually decide on a percentage of the revenue that you're making. I usually recommend something in the beginning of aiming for 20% of your net revenue. Let's say your product costs €50, so target for 10, 15 euros cost per acquisition. But if your 50 euro product generates more sales over time, up to 100 euro, why not spend twice as much in cost per acquisition? Meaning 20 to 30 euro instead of 10 to 15 euro. Because you know that you get the money back within 12 weeks if you have confidence in your numbers. And Facebook Analytics should give you more confidence in your numbers because it's very good at keeping the user ID consistent over a long period of time. And I hardly know a better tool than doing it in your database by hand, by SQL. And that shows it to you in this nice cohort analysis way. This opens you up to a complete new level of potential investment in cost per acquisition. And why does this matter? Because in e-commerce, we are usually in a competitive market, and whoever is willing to spend more for the acquisition of a customer is going to gain more market share. That's just a natural law. It's a real-time bidding system, and if you keep on bidding higher in the auctions, you will win more auctions over time. The only thing is that you have to make it sustainable, and by looking at the customer lifetime value like this, you see that it is sustainable for you, and it should make even more keen to not only always focus on customer acquisition costs, but also improving your customer lifetime value, because that affords you to have a higher cost per acquisition. I hope this makes sense to you. If you have questions about that, you can ask them on Slido in a second. Back to the fundamentals. Why do we do all of this crap? We want to be able to see what the balance currently is of our cost per acquisition and our customer lifetime value, because only if the cost per acquisition is lower, we're going to have fun. Otherwise, we're going to go broke pretty quick, especially on high ad spends. So why do we do all this? We need to be able to act on the numbers that we see. If we see our campaign has a ROAS of 3.5 and higher, and that is our minimum, then what do we do about it? Hopefully you make the decision to slowly start scaling up the budget of your campaign. Don't overdo it. Algorithms are fickle things these days. A change like a 10% per day increase is already a lot for Facebook to take, but still within reason. Doubling, tripling, quadrupling your budget in a short period of time needs some finesse in the execution process. You usually want to go for a more slow and gradual increase. But you might also see that some of your campaigns do not have your minimum ROAS. Yeah, let's say it's 3.5 and you see only a 2.8. Here we have a 3.9, it's fine, let's scale it up, 2.8. Now if we lower the budget, there is less pressure on the auction, and the chance that your campaigns can become profitable again increases. So you want to scale down or even pause your campaigns. If you see after a certain amount of ad spend that is reasonable, that you have consistent numbers, you want to scale those down and you want to pause them. That's the game that we want to play. We want to use all of this analytics juju to be as precise and as fast as possible in our decisions about scaling our budgets and our investments, because that helps you increase your profits in your e-commerce store the most. Cool. If that's cool for you and you want to hear more about this crazy nerdy stuff, then subscribe to our YouTube channel. It's at getpirateskills.com/YouTube. Leave us a like and a comment. We are always answering the questions that we see there. I generally would really like to crack the first 1,000 subscribers really soon. All right, we talked about why analytics matters. We showed you how to improve your conversion tracking, managing cookie consent well, and what matters in reports and some tools around that. I understand that this was just 1 hour of input about a topic that is worth talking about for weeks, where you will need a certain amount of time invested to upskill, but I hope it shortens your learning curve and You can take some of those ideas into action and you can talk to me and ask me like if you did something right or not, or if I should look over something. And there are always other people in this Pirate Skills community that are very willing to help you. And at the end, we always have time for the Q&A. That's in the next part.